So starting with the Fed meeting this week, which to be honest was a bit of a snooze fest. They did hold rates steady as expected, and they didn't really give us much clarity. What stood out to me most was Jerome Powell saying the word waiting 22 times in the press conference. Kind of reminded me of the old Allen Iverson practice press conference. So if you're wondering what the Fed is doing, the answer is waiting. They're waiting to see what happens with inflation, waiting to see how tariffs shake out, and they're waiting to see if the labor market cracks. Now, Powell did say the economy is still in solid shape, but the numbers don't really agree with that. We just had a negative GDP print, job openings have dropped, and the time that people are spending unemployed is on the rise. Yet, no mention from the Fed about those, revisions to the jobs reports that we've talked about and been seeing, or the QCEW numbers showing the labor market is not nearly as strong as the headline numbers suggest. And meanwhile, other central banks are starting to move. We saw the Bank of England cut rates this week, and again, we're holding steady, but based on numbers being adjusted for inflation, our Fed rate is still extremely restrictive, and it could take 6 to 9 months for any cut to actually work its way through the system, which makes all this waiting, that much more painful. And it could be too little too late if they decide to, just like it was when they finally decided to start hiking rates. And now we can talk about trade. The US and UK have announced a trade deal, at least the framework is set, and it'll be good for farmers and basically remove tariffs on cars, but it hasn't been so great for mortgage bonds. It did boost stocks, but it hurt us a little. And the same thing could happen this weekend because the US and China are sitting down for tariff talks, and if there's a breakthrough, it could hurt bonds again, but if no deal is made, the market might breathe a sigh of relief. And I know it all does sound very backwards, I know, but in the housing world, consumer confidence is shaky. Just 23% of people think it's a good time to buy, and only 17% think it's a good time to sell. Affordability is, of course, still the elephant in the room, and we have a number of solutions for that. Just reach out if you'd like some help there. But here's a big sign for reality in the future. Consumer expectations are in the pits. Having, lower expectations for income growth, more people are feeling like they're in a worse position than they were last year. And when asked about expectations for unemployment to move up, it's moved to its highest level since April of 2020. And you can probably remember the lockdown started in March of 2020. So, yeah. Even though active listings are up, we are still far below pre-COVID levels, and we have a much larger population. So, that's good for housing appreciation at least. But the Fed is holding steady, and markets are hanging in there. But we're not out of the woods yet. If inflation stays flat or moves lower and job numbers come in weaker, rate cuts are still on the table this summer. But if tariffs push prices higher, we could be stuck in a holding pattern a little longer. Next week, just keep an eye out for CPI and PPI. Those are inflation readings. We're also going to get retail sales and housing starts as well as permits. But I'll be back next Friday to let you know how they look and what clues that gives us for where rates are headed. Have a great weekend.